Hello and welcome to today's video, where we'll be exploring some of the most common and powerful trading patterns that every trader should know. Over the next 10 minutes, I'll break down what these patterns are, how to identify them, and why they matter in your trading journey. By the end of this video, you'll have a clearer sense of what to look for on the charts and how to potentially improve your trade entries and exits. 1. Introduction to chart patterns. Chart patterns are visual representations of price movements that tend to repeat over time. They're essentially the collective result of buyers and sellers interacting in the market. Recognizing these patterns can help you anticipate potential price movements, though never with absolute certainty, of course. Nevertheless, many traders use these patterns to spot reversals, continuations, or areas of indecision that might lead to trading opportunities. 2. The head and shoulders pattern. Let's start with one of the most well-known reversal patterns, the head and shoulders. This pattern typically appears at the end of an uptrend and can signal a potential shift from bullish to bearish momentum. It's comprised of 3 peaks. 1. Left shoulder, a swing high that emerges after a noticeable uptrend. 2. Head, a higher peak that forms after the left shoulder. 3. Right shoulder, a lower peak following the head, often similar in height to the left shoulder. Below these peaks runs a neckline, which serves as a key area of support. When the price breaks below the neckline, especially on increased volume, it often indicates that the uptrend may be reversing to a downtrend. Conversely, the inverse head and shoulders is the bullish counterpart, found at the end of a downtrend and indicating a potential move higher if the price breaks above the neckline. 3. Double top and double bottom. Next up, we have the double top and double bottom. Both are classic reversal patterns as well. Double top, formed when the price climbs to a peak, retraces, and then climbs to a similar peak without breaking higher. If the price fails to surpass that previous high, it often signals a weakening uptrend. A breakdown below the retracement low confirms the reversal. Double bottom, essentially the mirror image of a double top. The price falls, bounces up, and then falls again to a similar level without making a new low. A break above the interim high between the two lows usually confirms a bullish reversal. These patterns tend to be most useful on higher time frames, such as daily or weekly charts, but can also appear intraday. Just remember the golden rule: the more occurrences and the larger the time frame, the stronger the conviction. 4. Triangles. Ascending, descending, and symmetrical. Triangles are continuation or consolidation patterns that frequently occur in the market. There are 3 main types: ascending, descending, and symmetrical. 1. Ascending triangle, identified by a horizontal resistance line and a rising trendline underneath price action. As price bounces between these 2 lines, it creates higher lows but is capped by a similar high. When the price finally breaks above that horizontal resistance, often on higher volume, it signals a strong bullish continuation. 2. Descending triangle, the exact opposite of the ascending triangle. Here, you have a flat line of support below the price action and a downward sloping trendline above. The pattern often foreshadows a breakdown if the price breaches that support level. 3. Symmetrical triangle, formed by 2 converging trendlines, one sloping down and the other sloping up, leading price into a tighter range. A breakout in either direction can indicate continuation of the prevailing trend. However, symmetrical triangles can break in either bullish or bearish fashion, so traders typically wait for confirmation in the form of volume and a clear, decisive break. 5. Flags and pennants. Both flags and pennants are short-term continuation patterns that typically appear after a significant move, up or down. They often signal a pause in market momentum before the price continues in the same direction as the preceding move. Bull flag, think of it as a small rectangular pullback after a strong bullish climb. The flagpole is the significant upward price move, and the flag is the minor downward channel that follows. Once price breaks above the flag's upper boundary, it often continues in the original bullish direction. Bear flag, the opposite scenario. After a swift downward move, the price forms a slight upward channel. A break below this flag can signal continuation of the downtrend. Pennants, very similar to flags but take on more of a triangular shape, with converging trendlines. After an impulsive move up or down, the price consolidates in a tighter range, creating a pennant. Once it breaks, it often resumes the previous trend. 6. The cup and handle. The cup and handle is another bullish continuation pattern that traders often look out for, especially in stock markets. It resembles its name quite literally. 1. Cup, a rounded, bowl-shaped formation that typically forms after a strong advance. This curved shape suggests a gentle consolidation or a period of profit-taking before the trend tries to continue upward. 2. Handle. After the cup peaks, the price usually forms a smaller pullback or sideways channel. This smaller formation is the handle. A decisive break above the handle's resistance often indicates that buyers are stepping back in, and price may continue moving higher. While the cup and handle pattern can appear on various time frames, many traders consider it more reliable on larger frames such as daily or weekly charts, especially when accompanied by a noticeable increase in volume upon breakout. 7. Key candlestick patterns. In addition to classic chart patterns, certain candlestick formations can offer quick clues about market sentiment. Let's briefly mention a few. Engulfing candles. A bullish engulfing candle occurs when a small red candle is immediately followed by a much larger green candle that completely engulfs the prior bar. This suggests buyers have overwhelmed sellers. The bearish engulfing is the opposite scenario. Hammer and hanging man. Both candles have a small body and a long lower wick, indicating a rejection of lower prices. A hammer is bullish when found at a market bottom, while a hanging man can be bearish when found at a market top. Doji. A candle where the open and close are nearly the same. This reveals a market in indecision, where neither buyers nor sellers have a clear upper hand. Doji candles often appear before a pivot or when momentum is about to change. 8. Risk management and confirmation. Recognizing these patterns is helpful, but successful trading involves more than just spotting shapes on a chart. Here are a few critical points to consider. 1. Volume confirmation. Many traders rely on volume spikes to confirm a pattern's validity. For example, a breakout from a triangle or a neckline often carries more weight if volume surges at the moment of breakout. 2. Stop loss placement. Before you enter a trade based on a pattern, always know where you'll place your stop loss. This helps protect your capital if the market goes against you. 3. Time frame. Patterns can appear on any time frame, but they usually carry more significance on larger charts. For instance, a double top on a weekly chart is often more reliable than one found on a 15-minute chart. 4. Additional indicators. You can pair these patterns with technical indicators such as moving averages, RSI, or MACD to enhance confirmation. Multiple signals increase the confidence in a potential trade. 9. Examples of combined analysis. Let's walk through a hypothetical scenario of combining multiple signs. 1. The market has been in an uptrend for weeks, forming consistent higher highs and higher lows. 2. Price begins to form what looks like a head and shoulders pattern. The first peak is slightly lower than the second peak, and the third peak matches the first in height. 3. Volume gradually decreases on the right shoulder. 4. RSI is showing bearish divergence, meaning while the price made a higher high, RSI made a lower high. This often hints at weakening momentum. 5. Finally, the price breaks the neckline with a surge in volume. In this scenario, a trader might see these clues aligning and decide to enter a short position, placing a stop loss just above the right shoulder. The combination of chart pattern, volume clues, and indicator signals gives a more robust case for the reversal. So guys, whether you're day trading, swing trading, or investing for the long run, understanding these patterns can give you a strong edge. Focus on practicing them on different time frames, confirm with volume and possibly other indicators, and always keep your risk in check. Thank you so much for watching. If you found this video helpful, make sure to hit that like button, subscribe for more trading related content, and leave a comment below about which pattern you're most excited to try out. Until next time, happy trading and stay disciplined.